Hey everyone, it's Adrienne Pessel here. Today's topic is going to be VA assumptions. I'm going to give you an overview and I'm going to talk about why do we want to even do a VA assumption, who's eligible to do it, and what are the pros and cons. So the concept of a VA assumption is that you're going to take over the seller's existing loan balance and their interest rate. This is all pending lender approval, which could save you a lot of money. You'll have a lower monthly payment because you have a lower interest rate. Your closing costs will not be the same because you're not originating a new loan. Okay, now let's talk who can assume a VA loan. Pretty much anyone can. A civilian, active duty, a veteran, you just have to qualify for the loan. And VA loans are on all types of homes. Let's talk about the why. The why if you're a buyer and the why if you're a seller. If you're a buyer, you get a lower interest rate, which means you have lower monthly payments. You don't have PMI, you're going to just have a reduced funding fee taking over the veteran's loan. Now, if you're a seller, you got some good stuff working for you as well. You have lower closing costs. You have maybe the opportunity to hold a second trust for the new buyer. It also puts your home higher up in the standings among the competition, because if I have a choice of buying your home and having the opportunity of getting a lower interest rate as opposed to creating a new loan, I might be willing to pay a little bit more for your home. Also, assumptions can be made to spouses. So if a family was going through a divorce, one family member can have the other family member assume the loan, therefore making the situation a little bit easier dividing up the assets. Let's get into a little more detail. So remember, the buyer takes on all the terms of the mortgage, all the obligations. The buyer has to have sufficient credit scores. Most lenders want the debt to income ratio to be 41%. The buyer usually pays for the 0.05% funding fee, and all loans must be brought current prior to the assumption. So if there's any fees to be paid, that all has to be done. And remember, the bottom line is that the lender makes the decision whether the buyer is qualified. Let's talk about the seller's concerns. The main part that a seller needs to be aware of is if the buyer is not a veteran and not able to substitute the VA eligibility, then that leaves the sellers with some risks. One of those risks are if the buyer defaults, then the portion of the eligibility that was used in that listing may not ever be restored. So that means the amount of money that the veteran can use for their next home will be limited. Also, that means the loan can be assumed over and over again. Lastly, the sellers really need to be aware of the gap money. So where is the buyer going to get the money to make up the difference between the veteran's loan and the difference between what they're going to sell it for? Because the buyer will need to qualify for that amount as well. Let's talk about the buyer's concerns. There's a few of them we need to cover here. The first one is, how much money is the gap between the assumption and the actual contract price? And where and how are they going to get that cash from? Is it going to be from their own savings account? Is it going to be a second trust? Or are they going to do some type of home line of credit? And if they're going to be borrowing the money, what's the interest rate? Normally, second trusts are always higher than first trust, because they're at more risk of getting paid. So you want to make sure you do an analysis between the low interest rate of the assumption and the higher interest rate of the second trust to make sure the monthly payment is in the range that you want. Also, with assumptions, they usually take a little bit longer, so you want to find out from the original lien holder what their time frame is. As the buyer, you also want to make sure it's very clear on who pays for what and how much. I would also recommend to buyers that they have surveys done to make sure that they know exactly what they're getting into, because when you assume someone's loan, you assume all the responsibilities of everything that goes with it. Okay, let's talk about what the listing agent needs to check on in addition to the usual tasks they have to do. First of all, they need to call the assumption department of the seller's current lender and get the details of what that lender requires for the assumption and confirm the rate and confirm the term. What is required as a debt to income ratio? Is there a minimum credit score? What is the cost of this assumption? And what's the time frame the lender thinks they'll be able to get the buyer's loan approved? This sometimes can take up to 120 days. And finally, is the seller current on their loan? Once the agent figures that out, then they need to start marketing the property, whether it's going after veterans or to the general public. And does it make sense if the seller wants to hold a second trust? It's all about the interest rate and how much leverage that has. The buyer's agent's job is to confirm all the information from the lender and then to make sure that the second trust, the cost of that the buyer is going to incur in having a second trust, makes sense in comparison to the low interest rate of the first trust. Make sure you get everything in writing and all parties know who is paying for what. Bottom line, make sure you know what you're getting involved with. Know the pros, know the cons, and then make an educated decision. If you have any other questions, make a comment below or reach out to me. A special thanks goes out to Bobby Dickerson, who helped me with this video. Reach out to her at First County Mortgage. Have a great day, everyone, and please subscribe.